Uh, Good morning, everyone, and I hope you're having a good morning. Welcome to this presentation. My name is Francis Nasiomba. I'm the CEO of Raising Capital, also the founder, and we've been at this for the last more than 6 years. So I'm happy to have you on board. I'll do a more detailed introduction once we start with the presentation. Looking forward to this session, excited to have this conversation, and I'd encourage you to ask as many questions as possible. And I think they can do that through the chat, and we'll try our best to actually be able to answer you. So let's enjoy the next 1 hour. It may be shorter, it may be longer, depending on how exciting the session goes, and look forward to the next steps. So I'll have my colleagues put up the presentation, and happy to have you all here. Thank you. Maybe I'll ask my colleagues, or would you like me to present? Here we go. Thank you, everyone. Yeah, so we'll jump into it. I know we are all busy, but I think this is an important conversation that we need to have. Today, we are going to focus on pathway to growth, and it's a guide on investor readiness and raising capital. We can move on so that I give you a little bit more on the introduction. To the next slide, please. Yes. So, as I said earlier, my name is Francis Nasiomba. I'm a CFA charter holder. I am the CEO of Raising Capital. I've been around for the last 17 years in terms of being in accounting, financial and investment, private equity, and currently supporting businesses in accessing capital through advisory. I'm also the founder of Capital Connect, which is a product of Raising Capital. And this is a platform that we have rolled out to ensure that we can actually help SMEs be able to access capital in a far much more affordable and time-efficient way. We'll talk a little bit about it as we go along, but looking forward to progressing that. Thank you. Raising capital, just a brief on it. Raising capital has been around since 2015. We have been actively in the business since 2019. That's when we now launched the full-fledged entity. We do transactions across East Africa, and we've done transactions in Ethiopia, Somalia, Kenya, Tanzania, Rwanda, and Uganda, and a bit of DRC. We currently have transactions in almost all those countries. We help African businesses raise capital or access capital, and we use our expertise across different business lines. One is the corporate finance advisory, and in these we have what we call the capital raising element, which is where we help businesses to raise the capital itself. We also have what we call corporate finance advisory services, and this is where we offer services not towards raising capital. For example, you may say you want to do a valuation. A valuation does not necessarily mean there is a transaction coming up. It may be for accounting purposes, it may be for just knowing how the business is progressing, or how you're just trying to gauge yourself. At the same time, we also have Capital Connect. Capital Connect is an online capital raising platform. And what we do on Capital Connect is we give SMEs the tools for them to raise raise capital. So we'll talk a bit about it, but you want to value your business, you want to know which investor you can talk to. That is where we do it on Capital Connect. So it's online, it's live. We currently have more than 450 businesses, capitalconnect.africa. We also help businesses access capital through our third product, which is Impact and Programs Advisory. And here we help entities, institutions which help SMEs to be ready for capital raising, to roll out the programs. But we also do that in terms of helping the businesses themselves in terms of readiness. So there is a bit of training, there is a bit of sell-side due diligence on that. There is a bit of basically being able to just use tools to figure, is the business ready for capital raising? And that's what we do on the Impact and Programs Advisory side. Let's get the next, please. Corporate Finance Advisory has a number of elements. One is investor eligibility and readiness. If you come to us and we're having a conversation, this is literally the first thing we'll be talking to you about. We'll ask a number of questions: the sector you're in, how long you've been in business, how much revenue you're doing, what do you intend to raise the capital for, how much are you raising, what structure are you looking at. What that helps us see is, are you eligible and are you ready? Now, if you're not ready, if you're eligible, we'll proceed. If you're not, we will actually give you direction on how to be eligible. If you're not ready, then we go to what we call preparedness. And this is where we basically prepare you for capital raising. So we'll help you prepare the financial model, do valuation, prepare the documentation, marketing material, which is the pitch deck, the teaser, the information memorandum, and also do a sell-side due diligence. Part of the capital raising advisory also involves in matchmaking to investors. Unfortunately, many businesses think this is what we only do. And unfortunately, businesses think that capital raising is just matching to investors. It's not. This is just one of the steps. And in this, we look for the suitable investors. We currently engage with more than 400 investors on a continuous basis. We have access to more than 5,000 investors that we can talk to when we see an opportunity. So this is where we match you to the right investor, pitch the business, negotiate term sheets, and just manage the relationships until there is full commitment. And then the most exciting part, at least for my team, comes on the capital raising and structuring. This is where we get an investor who's willing, a business who's willing, but there's always things that are creases that need to be ironed out. And that's where the structuring comes in. Doing the investment structuring, due diligence support, negotiate the transaction all the way to transaction close, what we famously call money in the bank. And that is the corporate finance advisory element. We can offer these as pick one or as a full buffet, or you can actually just pick a service. We have people coming in and saying, look, I just want a financial model, or I want a valuation, or prepare the documentation for me. Some actually even just say, we have an investor ready, but we don't know how to negotiate it. Come and help us in negotiation. That is what we do in the corporate finance advisory. Capital Connect is our latest baby, exciting. Capital Connect is an online capital raising platform. And what we do is we offer SMEs tools to raise capital. And these tools include you being able to self-assess on your eligibility, self-assess on your preparedness, self-assess on impact. And all these you generate reports online. Also, we match you to the investors. We provide you a database of investors so that you can choose which investor to talk to if you don't want to engage them through the platform. We also provide other tools, including valuation, which is coming up, and verifying your business, because many investors don't want to engage before verifying. We always say investment, there has to be a handshake. So this is just a first step. Make sure it's efficient, make sure it's cost effective. Then after that, once you get the investor that you need to progress the conversations offline. And we always insist, whether you come back to us or to any other advisor, please do not do a transaction without an advisor. Your bank is not an advisor. The investor is not an advisor. They are investors and they're looking out for their interests. You need to have someone by your side who knows this from a day-to-day, who looks out at your interest. I'll touch a bit around this in terms of how the platform works. So in the business, I've talked about it. The platform provides investors with a portfolio of qualified businesses. We provide not just the businesses, but also the analytics around the businesses. What businesses are raising, which sectors, which countries are they on. It's an African platform. It's not a Kenyan one, but you get to see what you only need to see. As a business also, you can choose to have an advisory session on the platform. So instead of you traveling all the way, coming to our offices, sitting down or organizing a coffee and all, you book a session online, very affordable, and then we go through all the things that you've shared. We profile you with advice, and then from there you can choose on which direction to go based on the advice that you've given. Some analytics on it. We currently have more than 450 businesses on the platform. We have slightly under 70 investors. We are continuously building partnerships. We have advisory sessions also. The businesses that are on the platform currently more skewed towards East Africa, but across 8 African countries. And you can see how they're distributed according to sectors. Of course, technology is the biggest. This starts showing you a bit of information because you'll ask yourself, for example, why is food and agribusiness not a major number of businesses on the platform? And this just tells you maybe they're not seeing that they can raise, or they're raising their capital from somewhere else, or maybe they just don't feel they are ready to do it. And all this data, including additional data, is actually important for investors and also for businesses. The investor readiness training, or what we also call the impact and programs advisory, basically does a whole lot of these things in terms of preparing businesses around training. So we train the businesses on being ready. We train the businesses on strategy with our partners that we work with. We also do financial planning and projections training, and also look at legal and regulatory compliance. We have the online self-paced. We have also the instructor-led, and sometimes we also organize the physical sessions on that. This is the team that's helping drive that, led by myself. We have the tech team there. We have the investment professionals, and basically with this team, we can actually be able to fully support you. We have a significant amount of experience across the team, and across this team, we've done a whole lot of transactions together. We believe we have the capacity to support many of the SME and larger transactions that are in the market. Great. With raising capital conversation and introduction out of the way, I don't know if there is a question. If there's none, I'll progress. But I'll allow my team that if there's any question, you can always stop me, and then I can answer the question so that it doesn't become a monotonous conversation by Francis. So if there's no question, if there's no comment, allow me to jump into the next session. Thank you. So I'd like us to discuss a bit around the capital raising process. And yeah, raising capital borrows its name from raising capital, the process. But the process, one thing that everyone confuses and thinks is the capital raising process is they think matchmaking is the process. By the time you go to an investor to match a business, you need to be talking to the right investor. You need to be ready. Investors talk to businesses every single day. So they do not have the luxury, the time, the capacity to talk to someone who's not speaking their language, who's not prepared, who's not giving them the right answers. So where do you start? You start by the investor eligibility and readiness. Eligibility basically is the lowest form of should you even be going to market. Some of us in business should not even be fundraising. I know it sounds wrong, it sounds rude, but some of us should only be talking to our family, friends, and what we famously call the fools, the 3 Fs in industry terms. And the reason with that is if you go to an institutional investor and you are not eligible for what they are looking for, they may not talk to you. You will waste your time, you will waste their time, and probably they may not even want to see you next time. But assume you're eligible, assume you have been prepared and you're eligible for raising. What's the next thing? The next thing is you need to be ready. And I'll use a very simple example. You may have done your degree, your master's, and you're ready for employment. You even have maybe some experience somewhere. But if you don't have the proper CV to communicate your experience, if you do not know how to present yourself, then you're not ready and no employer will give you the role. Same to investors. So in that case, you need to be ready. So for you to be ready, you go through what we call the preparedness stage. And this involves having the right material, answering the right questions, and making sure you're clear on what you're trying to do. So this is where we will prepare the financial models, we will prepare the teasers, we will do the pitch decks or information memorandums. We will even do some valuation so that we understand if it's an equity transaction, where are we placing it. We'll understand the use of funds, the structure. This is where we also tweak some of the things you have in mind. A business may come and we see it a whole lot and say, I want to raise $1 million. But you look at the business and you're like, no, you'll not be able to raise $1 million. No one will even talk to you. Or someone comes and say, I want to raise $5 million. But this is a business that has been running for a long period of time. The entrepreneur has never had an exit. They are still struggling on the personal side, yet the business is doing well. And what we do is try to make sure that you take care not just of the business, but also the entrepreneur. The advice here could be you may need to consider also having some element of buyout so that as money is injected in the business on your personal side, you're also running effectively. That's the preparedness. And we do that a whole lot. Then we come to matchmaking. Currently, like I said, we have a database of more than 5,000 investors, and we can give it to you that are investing in Africa. And that list keeps growing, and I think it will accelerate even more because Africa is becoming the new frontier. We have the highest number of growing economies, the largest number of the growing population, and I think one of the only continents having a far much faster population growth. So more money is going to come this way. But are you talking? If you're not talking to the right investor, then you're actually going to get a challenge. Next, once you talk to the right investor, we have the alignment, we solve all the initial things. We need to structure the transaction. This is where the negotiation comes in. We negotiate the term sheet, we support on due diligence, we query and structure the transaction around all the matters that have been raised, all the way to having the final documentation. If it's a debt, then conclude on it. If it's an equity, then get all the conditions fulfilled, including regulatory approvals. And after that, we go to what we call money in the bank. Of course, that's where the excitement comes in. This process can take long. If you are not prepared from step 1 to step 4, you may take, at best, if it's equity, 3 to 6 months. If it's debt, it can be shorter. It takes sometimes even longer, especially if entrepreneurs are not clear on what they are looking for. I've talked a bit about eligibility, and I'll just dig a little bit deeper into it. And I want to encourage you to just keep asking questions so that so that you can be able to answer most of your questions. Eligibility, basically, this is where we look at the qualities of the business. So, is it a scalable business model? Investors, funders by nature, they want to see a business that's scalable. And if it's not scalable, they want to know that if they give you the financing, if it's even debt, you can actually be able to repay the debt. You need to be clear on your revenue generation. So you cannot have a business and you're not clear where the revenue will come from or where the sustainability will come from. You need to be clear on the team and leadership. So where's the leader? Who are the leaders? Who runs the business? And what are the structures around that? There's around legal and regulatory compliance. One of the funniest things that I always get, and we've always seen, is someone coming and telling us, I have an idea for a business. They're like, okay, tell us. And I'm like, no, I can't tell you. Like, okay, so what do you need? I need to raise capital, but you can't tell us yet you need to raise capital. Okay, have you registered a company? No, I don't want to register because if I do, someone may steal my idea. Now, I think you can see the challenges that come with this. It means that actually we are not going to be able to help you, and no one will invest in you just because you have an idea. You have to be able to communicate it. So if you have all these not in place, then it means actually the opportunity may not there. Proven market need. For mature businesses, it's easier to prove the market need. For startups, it's a little bit difficult, especially if it's a very new idea. If it's a competition you're entering, then you need to be clear who are the competitors and how will you take the market from them. Next, please. On preparedness, this is where we actually work on making sure that the communication you give to the investors is adequate. So it involves having accurate financials and the right financial model. It involves preparing the business plan and being very clear on your business model, being able to communicate your what are you trying to achieve, where's the opportunity in the market, what are your products and services, how do you generate money, how do you make money, which is the business model, how are you planning to scale, what's the plan around that. And if you can see, you may have this, but how to communicate it to an investor may actually not be there, which is a very important thing. The other thing is, how do you plan to fund the business? Yes, you plan to grow. If we give you this money, is there another round that's coming? If you give you this debt, are you looking for more debt? Will it be adequate? Are you going back to the market? If we give you the money, what are you intending to do with it? What will be the impact of money? So you need to communicate all these things before the questions are asked. The whole idea of being prepared is so that the investor has all the questions answered, and all they remain with is, can I be able to work with this person? Do I trust them? And all that. And then due diligence readiness. This one takes a bit of time. Whether it's a debt transaction or an equity transaction, there has to be due diligence that's going to be done. And for us, everything is in place and on time. The documents are ready. If you have patents, they're there. The documents are well organized. The questions are answered. Any gaps that are there, there are always gaps. A business is like a car. There's always something that needs to be fixed. So those gaps, you need to be clear. What are the gaps and what are the risks because of the gaps? What are the mitigation and give all that. So this is where we just make sure that you are prepared to answer all the questions that will come. Continuing with preparedness, like I said, we've talked about the marketing materials, the teasers, pitch decks, financial models, business valuation, and the sell side due diligence. The importance is so that you can be able to communicate the offer. This is what I have. This is what I've done today. This is what I intend to do going forward, and you can join me on this journey going forward. It also makes the investors not waste your time, and you also not waste their time. An investor from a teaser will quickly see and say, you know what, not my thing, or yeah, this looks interesting, give me some more. When you give them some more in form of a pitch deck and a model, they may choose to say, okay, we've seen it, we don't like it, or we've seen it, we have questions, or we've seen it, we love it, can we progress? So it actually helps the process move far much more faster. Like they say, you'd rather sharpen the axe before you start cutting a tree. This is the process of sharpening your capital raising axe. Mistakes, you have no available information. We start so many processes and we're told, oh, we don't have financials, we have to prepare them. Now that rolls back the amount of time that's required. It means we need to make sure first the auditor does his job before we come in. You're not being clear on your capital raise. So how much are you raising? I'm raising $1 million, but maybe even two, I'm okay. If I get five, I can do this. So you're not very clear. And we help with that, but clarity helps a whole lot when you're raising. Disorganized information, due diligence, investors review are structured. There is financial info, there's tax info, there's governance info, there's legal info, there's business model info, tax. There's a whole lot of information. Now, if you just throw all this to the investor, then you're going to lose in terms of not only the process, but they may actually disengage. Whether it's a bank, whether it's a private equity, whether it's a family office, they go through the same place, and you need to pace and structure. So you need to have these organized. I've just mentioned structure in the process. Normally, the best way, if you're doing an equity, you do what you call a beauty contest, put everything together, identify the investors, control the narrative and the pace. But sometimes businesses are so desperate, they just start going out. In the process, they lose even more time. The final thing, and this is, I hope you can hear me. The final thing, and this is not just for us, you can actually use any transaction advisor, is trying to do these things without an advisor by your side. I ask simple questions. If you go to court, you're not going to go to court alone. You still need a lawyer. Even lawyers need lawyers. If you go to hospital, you need a doctor. If you, whatever you do, you need a specialist next to you to advise you. This is one of the most important decisions entrepreneurs and CEOs make. We find it very interesting when they try to run it alone. And we've advised very many clients and businesses which went alone and had to roll back and try to recover from some of the mistakes they did. So you'd rather work with an advisor who will walk you along and will give you the right advice. At the end of the day, the decision still remains yours. Matchmaking. I can promise you this is one of the toughest stages in this process. And it's a bit like dating. Getting the right person is not easy. He may be out there or she may be out there, but just being able to match and make sure this is the right investor I need to engage in becomes very difficult. You can imagine we are saying we have 5,000 known that we as Raising Capital know as investors in Africa. And you need to figure out who to talk to. You may go to the right one and then you find that maybe they've stopped investing. Or you go to the right one and you figure, okay, we've invested in Kenya for so much, now we are shifting to another country. So matchmaking is a difficult process. One, finding the investor. Secondly, the process of pitching to them, presenting the business to the investors, generating the initial interest, having to be able to answer the questions. There's a whole lot of back and forth, questions to management, maybe a visit, initial visit here and there. You also understanding the investor and being comfortable with them. And that's basically the investor relations and communication side of it. Once you are agreed and a term sheet is signed, or at least some high level offer is given, and either binding or non binding, then you jump into the due diligence. This is the things you told us. We now want to confirm, are they true? And that's why we tell entrepreneurs, please do not try to play around and give false information, because a diligent investor will find it out. And it's unfortunate when they find out while due diligencing, because they lose trust in you. So we normally try to front end and front load most of these issues and discuss them early on. Yes, we have this case, we've been sued. This is how we propose to address it. We have this tax matter. This is how we propose to address it, or this is how we are addressing it. That way, when due diligence comes, then you're not going to have another issue, which most of the time either will increase your cost of funding or actually reduce your valuation. So the importance of matchmaking, I think, goes without saying. You have to ensure that it's smooth. It increases the success rate. So you're not just guessing. You need to get the right investor. While they due diligence, you need to due diligence them. So it's not a matter of I'm desperate for money, bring whatever you bring in. You need to know that you can work with them. You need to know that they can back you. You need to know that if it's a lender, if it's a bank, if it's just a private lender, then they can actually to be flexible when things here don't go so well. You need to also just be able to see if the pairing works, because it's a long-term relationship. Mistakes, the main one we see, pitching to the wrong investor. We've had so many referrals come to us from investors who say, look, these are good business, they've approached us, but you can't touch them. When you go to check, someone is raising $500,000, $1 million, they've approached an investor who cannot invest anything less than $10 million, and so on and so forth. So wrong investor matching and approach, not understanding investor criteria. We do that on a continuous basis. Communication mismatch, you're giving the wrong information. We have to even train entrepreneurs and CEOs on how to communicate, because how you communicate to the board is not how you communicate to the investor, it's not how you communicate to the team, not to your suppliers or customers. So all these things have to be done differently. A lack of full disclosure, I think I've mentioned that. Hiding things, yet they'll still be uncovered at some point. Not having the relevant sort of information and readiness for that. And matching to existing investors. We will talk a bit about it towards the end, but you'll be so shocked at the amount of fraud out there in relation to what you call fake or fraudulent investors. I see a question from Audrey. From your experience, what do you believe investors notice first when evaluating a business? I think what they notice first is commitment. If you approach an investor and you're committed to the business, they'll see it. If you're not committed to the business, they'll also see it. And for me to trust my funding to you by whichever structure, then I need to see commitment to you. The second thing is, you may think you are being clever or not, but many investors can read if you are just painting a false picture. And I think for me, that's very important to just be clear from the get-go. Where's the business? What are the challenges? What are the opportunities? and how can the investor help in that. I hope I've answered you, Audrey, as we continue. The next we'll talk about is capital structuring. Now, uh, capital structuring basically is think of it of two people who intend to work together, but there's something in between that's holding them. Almost like a road coming from both sides of the river and you need to bridge it. Most of the time, what we do in capital structuring is actually in the bridging of those two conversations. And the process involves various activities. You have to negotiate the term sheet, which is the first document that comes and says this is the general pattern of how we want to structure this. And then after that, what is there has to go into the definitive documentation. Then there has to be due diligence before that, where some issues are raised and also have to be addressed. A good example I use is we did a transaction with one of the regulated microfinances, and they had a bad book. The investor wanted to do the transaction, the microfinance shareholders wanted to do the transaction, but the challenge was this bad book. And the question was, how do you resolve it? So what we did on our end, we hived it off, and we said, okay, because there was no agreement and it became a big deal, we said, what if we hived it off? What if we parked it, and any benefit generated from that sits with the people who sit with the risk, in this case, the current shareholders, but everything else in the good book and beyond sits with all the shareholders, including the new. And that solved the problem. And that basically is one of the simple examples of structuring. You need an advisor in this. You don't run capital raising every single day. So it's important that you have an advisor seated next to you for you to be able to do this. The importance, it ensures transactions completeness. Sometimes it takes very long just because you are not structuring it properly. It ensures you cover both sides of the interests, risks, and fears. Every side has a fear. The business has a fear. The main fear we see the entrepreneurs was the business would be taken over. And there are many ways to address that concern. The investor has a fear of what if I give money and it's diverted. There are many ways of ring fencing and protecting that. It helps limit fraudulent transactions. At structuring is where you can quickly figure out if a transaction or an investor is fraudulent or even a business is fraudulent, especially during due diligence. Lays out the framework of collaboration. How do you work together going forward? Common mistakes, again, doing it without an advisor, rushing through the process. I know all of us want money yesterday, but that is not how it works. You actually risk far much more with that process than just sticking it out and making sure you tick all the boxes. Entering fraudulent transactions. We had a client who approached us, and they had an investor, and basically they wanted a review of it and negotiate the term sheet. From the get-go, we did a report to them and told them this is a fraudulent transaction. Unfortunately, after that, they insisted on progressing. And from what we know, the fraud actually crystallized. So this is where I keep saying work with an advisor, because advisors, not just as many out there, including ourselves, and we really believe in our capacity, have seen this a whole lot and have experienced it. So the advice could save you a whole lot of time, money, and heartache if you work with an advisor, even if you have to pay, of course, for their fees. I see a question from Shalene Kimaru. Thank you, Shalene. What do you think are the trade-offs between giving up equity compared to taking on debt? I think I'll pick two trade-offs. Trade-off number one is, what is the future opportunity? Now, if the future is so bright and you're so confident in it, then you may need to say, okay, let me take debt. It has a cap on what I'm giving away, but I sit with all the risk. I believe my risks are far much lower compared with the opportunity, so I'm willing to take that. So when you take debt, know that the risk remains with you. And these days on, debt providers insist on personal guarantees. So you sit with that risk. If it works, good for you. If it doesn't work, it is you who has to sort it. The investor, in this case, the lender or the bank, doesn't care. They want to be compensated and made whole. So that's one trade-off. On the equity side, the beauty is to say, we now take the risk. We now take the initiative to grow this business together. If it works, we all benefit. If it doesn't work, then we all lose. The flip side of that is you have to give up a little bit more, a bit of control, a bit of future value, and all that. So there's always a trade-off. Depends with the circumstance and where the business is at that moment in time. Investor warning signs and what to look out for. Now, I'll go one by one, and what I'll do is I'll just use examples as I explain this. If you are raising $5 million and an investor gives you an offer, they've not looked at anything apart from maybe your term sheet, your pitch deck, or just your teaser. They've not asked very many questions. That is a red flag. You've not given much, they've not engaged with you, they've not looked at the business, but they give you a term sheet and they give you an offer just out of the blue and they don't know you. That's a red flag. Unclear terms. There's ambiguities in who owns the business, who's the investor, where are they from, what are the terms they give. Big red flag. If they ignore legal requirements or they're not concerned about regulatory approvals, or you tell them about how the company is set up and they're brushing it off, another issue. I've talked about unexplained funds. This one is basically, where's the money coming from? Who's your investor? Who's your limited partner, for example? Who's behind the fund? If that's not clear, then you need to worry about it. Legal issues. If you quickly Google an investor and all you see is a long list of issues that they've been sued by other entities, you need to be worried. There's no track record that talks for itself. It may not necessarily be a red flag, but it is, call it a yellow flag, something to say, okay, just let me put my antennas up. Upfront payments, this is big, and it's very common, and very common from actually one region of the world. We see it a whole lot from Europe. We see it a whole lot from Middle East, where here's an offer, but you need to pay X amount upfront. And that X amount is all facilitation, legal fees. And when you see that, you need to start getting worried. If you try to negotiate it and they give you lower offers, they say, okay, yes, now we can do it, but just give us less. That's also another red flag. And actually, for me, this is the biggest red flag. Any upfront fees. Investors, there are some investors who request for upfront fees to sometimes show commitment, but the structuring is very clear. But many of them these days go towards it, and all they do is they'll get their upfront fee and start giving you so many stories around it. I've talked about no due diligence. $5 million, $1 million, by any standard, is a lot of money. So for someone to give you that money without any due diligence and at some very interesting, exciting terms, that means you're actually probably walking into a snake den. Pressure to invest quickly. You need to make a decision. Here is the offer. If you don't make the decision, then we are going to shut it down. You'd rather not make that decision because you are probably either going to lose your business or lose money or lose time. And worse still, you're going to actually have some emotional, difficult roller coaster ride. Personal transfers, requests for funds to personal accounts, including having non-registered email communication. So someone tells you we are from this bank, but you look at the communication, it's coming from a personal account. You need to worry about that. No advisor or absence of a professional intermediary. Not a big one, but if an investor, because we are in this business, we do it daily, we can quickly tell you that conversation doesn't sound real. That person doesn't seem to know what they're talking about. So if someone is saying they'll invest in you $30 million and they don't seem to talk the right language, then you start worrying about it. For someone who's not doing fundraising every day, you may not see it, but we can actually see it a little bit early. We've had our run-ins with such. We have had our lessons, some of them very painful. So we actually are very clear and can actually be able to tell you this is a risk, and this maybe let's go and proceed with caution. Or this one, we know this investor, we know where they invest, we know them very well, let's run fast. I'll go to a bit of some of the questions before we proceed. Gideon, are the timelines for raising debt and equity typically the same? The short answer is no. Debt tends to be faster. mainly because the structuring does not involve the equity side. So the issues you negotiate tend not to be major. The due diligence tends to be more focused on, can you repay us? Do you have security? Is the business existing? Compared to equity, which is your story real? Is the business real? Are you someone we can work with? Because in equity, the risk is bigger. If the business goes down, the money goes down. But in debt, then there's a bit of mitigation, security, guarantees, and all that. Shalini is asking, how do you maintain a healthy investor relationship post investment? That's a very good one. One, please communicate. Many businesses, once they raise fund, then they go sit in a corner and try to do everything. If an investor doesn't know what you're doing, then they'll start thinking something is amiss. Secondly, be honest. You're already in a conversation, you're already in a partnership. If things are working, then communicate. If they're not working, then come out clearly and even ask for assistance. How do I do this or that? Communication includes continuous updates, quarterly reports, annual reports, maybe involve the investor onto the board, even if it's just on an advisory level. Give them maybe annual updates on where the business is. That is how now the investor starts feeling comfortable with the business. CJ, what is that one advice you'll give an entrepreneur to carry through their capital raising journey? Thanks, CJ. The biggest job for an entrepreneur, I don't know who said this, and apologies to them, is that you need to make sure your business is always funded. The biggest advice I'd give an entrepreneur is start raising capital when you do not need it. We normally start raising capital when it's too late, when there is a cash flow challenges, when there is a risk that has crystallized, when there's an opportunity that we need to jump on and now we are not ready. You'd rather always have extra rather than you not having the extra. The second advice I'd give, I know you've said one, I'll give two, is always be prepared. I was a scout, and the scout's motto is be prepared. Always be prepared. They say luck is when opportunity meets the prepared. Always have everything in place. My colleague Gideon is rolling out a product where we always make sure that the businesses are always ready for capital raising. The information is updated, the structuring is ready, the use of funds is ready. We are even having maybe some initial conversation with the investors just to make sure the conversation keeps moving. We hello. Apologies for that technical issues. What was I answering? I think it was CJ, and I was answering the question around what advice would you give an entrepreneur to carry through the capital raising. So for me, I'd say be prepared. We are actually, like I was saying, we've rolled out a product where we make sure businesses are always ready for capital raising. And what we do with it is we make actually sure that it becomes even cost effective. You don't start running when you need capital. You are always ready for you when like we make sure you're always ready so that when an investor comes in, it's literally plug and play, and you can make sure your capital raising process is faster. So I'd say be ready and start raising capital before you need to raise capital. So it feels like it's the same thing. So yeah, that's the one advice I'd give. I don't know if there's any other questions for me. Okay. Without any other question, then I'd wish to close it here. I want to appreciate everyone who managed to get on the call. Sorry, I didn't see the numbers, so I hope we had some good number, and I hope we've added value to you. We help African businesses raise capital, and we help any size and every size of capital raising. That can be small tickets, and that's why we have the Capital Connect platform. We have the what you call the high touch advisory, where that's why we have the capital raising advisory, and it can be for raising capital or just pure advisory that does not necessarily have a capital raising element. And finally, we also help businesses in investor readiness training, and we help our organizations run their programs when it comes to helping businesses when it comes to the capital raising process. Before I close it out, I see a question by Shalin. How transparent should a business be about challenges or financial gaps during due diligence? My feedback, as transparent as you can, because a good due diligence will uncover it. And if it uncovers it and you lied about it, you've lost trust and probably you've just lost a transaction. Or if you've not lost a transaction, you're about to lose your value and significantly, so you get a lower valuation, or your cost of funding goes up because now you are a risk item. Otherwise, with that, if you want to reach us, there is my number. We have my email address also available. We hope we've actually been able to add value to you. We thank you for joining us. And you can check out more about raising capital on raising.co.ke. And you can go and sign up to Capital Connect. It's currently free on www.capitalconnect.africa. If you wish to drop an email, capital@raising.co.ke. Thank you. And I wish I had more questions. I was excited about that. But thank you so much and looking forward to supporting you. Thank you.